All right, so welcome once again. I think we are back to our macro discussion. Market has been pretty, I would say, frothy a little bit, but in general, we expected the bull run to continue. So I won't say it is surprising, especially given the big news of, we did talk about the Jackson Hole pivot. We did talk about how it will impact. A lot of people were questioning overall why it is a big deal, but we did talk about how it was a big deal and how market was really happy with that. And what happened afterwards with FOMC, that was already well telegraphed in that Jackson Hole speech. Already it was clear that unemployment is the focus. 2% is no longer a hard goal. It is a target which can be achieved in 2 years, 3 years. Doesn't matter whether we achieve it or not, because none of these people who are voting today are going to be there. So in short, what we are saying here is that this was very well expected and we got a confirmation. More importantly, market had already started pricing in 5 cuts by June, which also got confirmed with the dot plot somewhat. And I think there is still, I know that a lot of people are questioning. Very interesting thing about the dot plot becoming more and more spread out, more and more, I would say, disagreements within the Fed, which is kind of what is still spooking the market a little bit. So let's get into the specifics and we will share the screen and the usual market discussion. Let's go from there. I'm going to start sharing the screen in a bit. But anyway, coming back to the whole thing, like where are we today? We are basically looking at a rally, which is we are again making new highs every day. And it all stems from the fact that we are in an easy money cycle. So rate cuts have begun. And if you remember, this rate cuts had started last year when we had this 50 basis point cut around same time. And then we did another 2 cuts and then we stopped. What is happening now is market is seeing this as another cycle when, as I just discussed, the dot plot is confirming around 4 to 5 cuts in a very quick succession in next 8 to 9 months. Specifically, by end of this year, 2 more cuts are expected in the next 2 meetings. And I think that is what is creating this more flood of money. And why do you think that's the case? Because very simple. As you see, there's a $7 or $8 trillion in sitting in money market funds, earning nice 4%. Last year, they were earning 5%. And soon this will go down to 3 and probably 2% if the rate cuts materialize the way they are positioning it. What does that mean? That means that people who were sitting outside the market waiting for corrections, they are never going to get even those fixed income returns. So this is where I think there will be some kind of FOMO. People are feeling missing out. And that is what I think is driving a lot more of this rally. And most importantly, if you remember 2 weeks back, we were talking about how NASDAQ is still kind of not able to break out from the previous all-time high, which it made in early August. But I think of what we saw in last 2 weeks, ever since things have become clear that we will have more records, the tech stocks are again rallying. I think one of the key things which happened also was the Oracle earning and all the euphoria around huge order book and so on. So I don't want to debate that because there are all kind of analysis about how they misrepresented that. But overall, what we are trying to highlight here is that AI euphoria is back. We are seeing a lot more news around big contracts, whether it is OpenAI talking about and Oracle talking about big deals, or whether it is the sovereign nation investing more and more. If you look at the recent visits of Trump and to UK and so on, it's the trend that every time they talk about new investments across the board in AI, because AI is the theme, spending is continuing, and you see like how many green days you can have back to back. Like this is again we are getting into a euphoric market with cheap rate cycles. So this is where we are. Means again, as I always say, it's very difficult to predict where it will be tomorrow, but it's very clear like how many green candles you can have back to back. This is a daily chart. So we are sitting on a pretty huge bull run in last few days. And that is from basically a perspective of, we are not even seeing any kind of a correction in this move now. And this is what we call as a confidence of the market. And the confidence comes from the fact that rates were already low and we had as we were talking about. On the other hand, 10-year is definitely inching up a little bit because people are worried about overheating with these rate cuts coming. And also it's more of I would say, a correction of, in the bonds because people were rushing into 10 years and they are going back. Maybe I would not be worried till it breaks any of these downtrend lines, which we have been tracking. But overall, yes, we are still in this kind of a euphoric state. So where are we in terms of overall market cycle, I would say this is purely a money supply game. Once you have all the concerns gone about high rates or Fed not cutting, now we are just looking at how high we can go. We are in a blue sky zone, so nobody knows where it stops. It can be 7,000. It can just start correcting tomorrow. But how do you play it? As you know, means if you are part of All Access, we have been talking about it. We were long, we were also hedging, because we know that we are sitting on a huge rally. We know that we have not seen a huge correction since then. We did have a little bit of correction early August since the August 1 tariff. We did have some other minor corrections. But this is now we have no other news till the next earnings cycle start. So the next 1 month, I think we are basically waiting. And if this rally continues, we may see new highs, especially now that the tech has broken out. Now, what are the other factors? I think gold is another factor which we did talk about 2 weeks back, that how it is breaking out after a huge consolidation. So gold has been actually the leader of this cycle because it is showing you that because it has no earnings to beat, it has no news impact. All the news we see is that somebody like China or some other sovereign nations are accumulating more and more gold, which is very clear. So what you're seeing here is a multi-asset rally. It is not a rotation. It's more about, you can call it as a new money supply coming in. People are realizing that the dollar is getting devalued. And it's the same thing which we also discussed a little bit in some other groups, I think on the WhatsApp also, we have been talking about. So what is really happening is that the dollar is designed to be devalued. This is what they do. Once you reduce the tight money policy, which was, what do you mean by inflation control? When Fed was talking about we have to keep the rates high, and when they were focusing on inflation, what that meant is that you are basically trying to keep the value of reducing inflation means you're keeping the value of dollar intact. As soon as you let go of that, and now they're saying they're focusing on unemployment, and when employment is your goal, that means market is just feeling comfortable piling up into assets now again. And that's the message which you're seeing across all kinds of asset classes. The only other asset class I think which is not really yet reaching new highs is Bitcoin, which actually front ran this whole rally. As you know, we made new highs. But on the other hand, we have, as we discussed also, and this is one of the alerts we gave, I know, which we were talking about before the call started in All Access. Our goal was not to, again, create a FOMO there, but the idea here was that it broke out. Yeah, the whole reverse head and shoulder pattern, which helped confirm the Bitcoin downturn, which had started in middle of August. It reversed. So it's looking right now in a mode that it is trying to capture its previous all-time high. But as we see, this is a place where we are seeing a lot of this zone is becoming consolidation zone between, I would say, 110K and 120K, now that we are seeing a lot more supply coming in. So it will be interesting whether Bitcoin follows gold. I mean, that is the typical, as we say, multi-asset bull rally has already started. It's continuing with easy money cycle. So I would say the expectation is that now that it has reversed, that probably it should continue. But again, the critical test here is whether it breaks out of this consolidation zone. So I don't think there is any clear technical breakouts either till we clear out of 120K or 124K, which was the last all-time high. So this is all we have in terms of charts. I would say a few things I would like to note here is we did talk about catch-up trades, right? Why Nasdaq can rally, because we do know that some of these leaders of like Nvidia's, Metas of the world had already rallied. Means they were almost sitting on all-time highs. There's nothing much there, and they are consolidating while the trades which are lagging behind, they are catching up, and that's where we had identified 2 weeks back also the opportunity. The opportunity is in some of these Mag 7, like Tesla broke out. This was one of the biggest trade we had in our All Access as well as in managed portfolio in last week or so. We saw Apple doing very well. So all these things are basically catch-up trades because the money is looking for a new home, because market is interested in putting cash into the risk assets. And where do you go? You go to the assets which have not appreciated enough. And that's what is happening here. Means I would say there are some other, like Google also, I think, has made a new high, which is a breakout trade again since last 2-3 weeks. So you're seeing new and new trades coming out of this in terms of Microsoft already had run up, it corrected and recovering. So overall, what I'm trying to highlight here is it's a rotation market. People are just looking for value where there is hardly any value. You are sitting on an all-time high. The money is rotating to, because the new money has to be deployed, and they are rotating into some of those which have not made new highs. And ultimately, the effect is that we are making, and now we have broken out of the previous, when I marked this new all-time high last time, we are going to now see another new high to be made. So this is the market conditions. As we always say, that there is hardly anything which can pull this market down when you have this whole money cycle starting with people are now feeling more and more comfortable. If you remember last Investor Day in the May, when we had talked about the key changes, right? We were talking about these same things. We were talking about the rates, which has to come down because at that time people were worried about inflation, and we were talking about how the SLR relaxation, how the other. I think before the call, somebody asked a question about the yield control. So I think Trump administration has made very clear that they want the 10-year down. And they have been fairly successful, I would say, because this is where you are talking about the peak yield was around when Trump was inaugurated. And since then, it has been on a downtrend, even though it's very spiky. You do see that it dropped in early April because of tariff, and then it went up again because of the concerns of the overheating. But overall, they have been successful. And as you pull down the short-term rates, the term premium is coming down. And if you look at the latest economic activity report from Fed, it was showing a lot of concerns, whether it's employment, whether it's productivity and all that. So basically what it means is that overall, we are seeing a downtrend in long-term concerns around inflation, long terms of, people are actually now more worried about slowing down of economy. What it means is that there is no way now this trend is stopping in terms of easy money policies. You will see lower rates. You will see no justification for slowing down anymore because now the focus has shifted from inflation to unemployment. So that's my summary, I would say, on the market. Having said that, remember that market always prices in things ahead of time. So it doesn't mean that now that the rate cut has begun, this was already priced in. If you see, the market is smarter. Stock market always try to predict future, not the present. It's not a commentary on present. So now where we go from here is anybody's guess because it's very visible from this chart that a correction is due. So I would heavily recommend, everybody should look at their portfolio and consider whether they are prepared for some kind of a correction. Whether it will be something like this means there is nothing which is showing us that sign. So I can only say that if you get something like a 3, 4, 5% correction in the market, that would be nothing. So don't take me wrong that when I say that market has nothing to lose right now, because you can always have corrections. What I'm trying to highlight here is at a macro level, there is no reason or no pessimism anymore in the market. And right now we are sitting at a very optimistic scenario, and which is reflecting in daily up move right now. So again, now I will take a few questions here. Just wanted to make sure that we look at where we are in a bigger picture view in terms of where market is, what everybody is doing. And while you are thinking about the questions or writing it down in the chat, let me just say one more thing is we are very excited to get back with our Investor Day. As I said, we did a very successful Investor Days earlier in May, and before that last year in December, we try to do it at least 3 or 4 events. So that's coming on October 5th. So you will soon see ability to, get your spot reserved. This time we are doing a lot of exciting stuff, like we are doing a hands-on workshop of, and discussion groups for people to talk about different investing topics, whether it's macro, whether it is portfolio management and so on. And usually, like we always cover macro view in much more detail in Investor Days, where we talk about specifically, just like I said, that how the last time we talked about how SLR will impact the liquidity in the market. Last time we talked about a lot of other things. And this time we are also focusing a lot on income investors, because I know that a lot of people invest in money market funds and CDs for their regular safe money investment, which can give you, and it was great for last 3-4 years because the rates were high. You can lock in 5%, 4%, and that is not bad for conservative money holding. And that is disappearing very fast. So this in next 1 or 2 years, what you're getting right now at 4% will go to 3% and probably lower if the rate cuts continue. So I think that is one thing we want to focus on, because that is a need of the hour, and we are getting a lot of questions on this from some of the community members. So we are going to cover some of that, and also in general, how to think about planning, looking at the macro picture. How do you plan your bigger part of your finance, not just making a trade here and there. So as I always say, getting a breakout trade on Tesla or getting a breakout trade on NVIDIA or something, you will only make money once. You need to, as an investor, your plan should be, how do I make 20, 30, 40% per year? Or even if you're a conservative investor, how do you make 5, 10% per year on a regular basis, rather than taking risks? So what I'm trying to highlight is, either way, it has to be a portfolio approach. You cannot think at trade level. That is not giving you anything other than just a gambling fun that I made a successful trade. So that is one thing which we always focus on in Investor Day, when we educate people and we talk about those things. So, and that's what we are also showcasing in, whether it's our all access product or whether it is the managed portfolio, where we are trying to generate consistent returns on a daily basis. And I think we also did a new product launch last weekend. Just for those who are uninitiated, we are doing a very exciting product, which is actually not only great for this market environment, but also a very big need in this Silicon Valley world, where people are looking for generating income out of their appreciated assets. So do watch out for more info sessions on that. There's a very huge interest in the Embark product, which we just created. We have institutional clients as well as individuals who are coming into that. So I will share more details soon, but just wanted to give this announcement. So let's do questions now. So I see a question in the chat. It says, if the tech is almost frothy, does it make sense to look at other sectors? I think the problem here is other sectors have actually suffered, to be frank. I mean, if you look at retail, whether you look at some others. So yes, there are some value play. If you see the Russell 2000, the IWM ETF has just made a new high after almost 5 years or 4 years. So yes, the other sectors were expected to benefit. But my question is, can they lead? Can they really outperform tech? Because if tech drops, that usually pulls down everything, because it's a money flow world. It's less of a fundamental world. It's more of a money flow world. So I'm personally not very keen on looking at that. But yes, if you have a lot of conviction in some stocks fundamentally, see, all the interest rate sensitive sectors will do great. You are already seeing benefits into something like automotive industry, or something like anything which has to do with the interest rate, like which are loan based consumers. All those will benefit. Probably you will see real estate reviving if the rates go down, because as we see the short term rates going down, you are going to see a lot more trickle down effect of long term yields also coming down. So in general, I would say some of these things may be value, but on the other hand, as I say, right, means if S&P 500 crashes because tech is crashing, uh, the money flow still pushes the valuation down for those value sectors. So, and by the way, if you are in All Access, we do have some great value plays going on there in Income Insider, which is designed for those kind of things. So definitely we do see value in investing in those, some stocks which are, probably safer to invest at that levels if you're putting new money. On the other hand, personally, we believe in continuing with the trend, using hedges and using options to manage the risks, rather than trying to find value somewhere where there is not enough liquidity and there is not much upside. So again, that's up to you to decide. But I would say, yes, there are opportunities, but probably the opportunities existed 2 months ago, because this rate cut was well telegraphed. Like Jackson Hole pivot, when it happened, that is when the rally started. Not really now. So the question to ask is, is it already too late for those? Means, because as I said, if the correction starts, all of them may correct. So there's no safety as such if you don't have a risk management plan. So but yes, tech, while it is frothy, it's also the brightest sector. It's also the brightest growth sector, I would say. When you look at, why is Tesla going up in last few days? Because of their Optimus news. There is this whole new excitement about their FSD and so on. Why is Apple going up? Because suddenly the people are realizing that even though they have missed out on basic AI thing, but they are the leader in distribution. They are the biggest brand. When they launch a new phone, everybody wants to buy it. So there was no need for Apple to be so depressed at that time. So this is why tech is still going to be the fastest mover even now. Money is going to rotate in that. But yes, I do see the opportunities in other sectors also, but we are not tracking that much. Please go ahead.
Yeah, so there appears to be debate about what drives mortgage rates. And I read that the 30-year can be thought of as the 10-year treasury plus an MBS spread and other risk factors. So how do you think about the weight of those pieces, and what are your relevant mental models there?
Sure. So let me tell you how it works. So as I understand, of course, I'm not a mortgage industry expert as such. My understanding is very simple that average mortgage get paid at 10 years. Nobody holds it for 30 years, even though it's a 30-year coupon. And most of the world, money world is benchmarking to 10 year, whether it's banks, whether it's anybody, because 20 or 30 years are typically just the term premium. They have no real relevance in terms of the coupons. So going back to 10 year, I would say that is what to watch for most of these things. And mortgage rates are more or less tracking 10 year. Secondly, I know a lot of people don't understand enough, but ARM in recent years has been becoming more and more short-term rates linked. There are a lot more and more banks who had issued in previous days SOFR, which is the overnight rates. Averaged of that as their benchmarks. So you will see that in last few years, more and more people have been scared of locking in very high rates. So you have seen the pickup of ARM loans again, and also they are going to be very much linked to short-term rates. So there are more of these scenarios. I would say 10 years and below is what will define the mortgage rates. But again, as I said, I'm not an expert in that industry. All I can say is that there are two things to watch now. One is whether now 10 years has started going up again. If you see, can it keep in this zone, or does it threaten the upside again? Because that will automatically pull up even the 2030. Even if you believe that 30 years is the benchmark for mortgage rates, all of them automatically go up if the 10 year goes up, because simply because of term premium. So I still track 10 years for this. Maybe I'm wrong. As I said, I'm not a deep down expert on mortgage industry, but my understanding is that it all is very closely tied to 10 years. And one more thing is not just that. I would say it's a matter of where is the focus, right? Means what is the focus of current administration? What is the focus of Fed right now? Um, 10 years may go up now because of two reasons. One is that when you let go of inflation as your goal, short-term goal, and unemployment takes center stage, basically you are heating up the economy again. So while the short-term rates are coming down, the long term will probably inch up, because people will be a little more concerned now in terms of the future of the rates. Because if you bring it down to 3%, which is now projected to happen by middle of next year, you are basically saying that there will be a lot more cheaper borrowing. There may be a little bit of overheating, and suddenly what stops us from visualizing, like market will start predicting that inflation will be much higher next year. And that's where I think it gets interesting for the bond investors. How do they balance this outlook on falling rates, and where is the balance on the unemployment? Should you read into the slowing down economy data, or should you read into what is coming in next 6 to 12 months with a lot of money flowing? So that is where I think the tricky thing is. But yeah, I mean, I don't have an answer for this if you're saying like, but definitely I'm not worried about 20, 30 years at all. I mean, that is usually a irrelevant discussion in most of the people. Like even if I talk to institutional investors or anybody, I've never heard anybody being bothered too much about 20 years or 30 years ever. I don't know why that suddenly became important, and why this is even in the news, because I've never heard that before. All right. So any other questions, let me know, but we can talk a little bit about the crypto sector, because I think a lot of people invest in that and they're interested. We did talk about Bitcoin a little bit on the, like how it has turned around. One thing which I want to highlight here is that we did talk about how this whole thing was blowing up in terms of the digital asset treasury companies. And what we saw in last 2, 3 weeks is, or maybe 1 month or more, since middle of August, most of those things are kind of really dragging the whole sector down, because there was too much froth. That is what we call froth, right? When every token which has no meaning to be on stock market is becoming listed. On the other hand, there is still billions of dollars being raised into that. So there is a institutional demand is good, because there is still this whole background story of how we are seeing the industry moving towards stable coins. We are talking about new stable coins being issued. There is a lot more clarity coming. So there are two big things happened. If you remember, we talked about Genius Act, and and there's another one which is being planned. Um, But when I dig deeper into this, I also see that these were just a first stage of act, which is with a lot of clarifications pending. So the real effects of these law changes have not happened. So there are two sectors right now. One who are basically, there is a hype after the Genius Act, and then there is a reality of when people start taking advantage of that. When do we start seeing the money supply in the crypto world increase? And I think that is a kind of a huge, I would say, upside which is pending in the whole blockchain space, in the stablecoin space, and it will have a trickle down effect on yields, because if you keep hearing Besant, he talks about a potential market for 5 trillion. So let's even cut it down by 80%. Let's say it's a 1 trillion. That itself is a 4x increase in the demand from stable coins in next 2 3 years. So this is where I think there's another side of opportunity. We are talking about a huge change in a sector which was developing very fast in last 10 years, but which was stifled by regulations, which is getting opened up. And just like AI is creating this whole wave of spending and new money being invested, there's always a trickle down effect of that. I think what they are trying to do is, and if you see even last couple of days, if you they have started this conference in the White House, they're talking about how to make use of these new laws to create new opportunities. And I think that is what is another thing we are tracking very closely. Some of these trades are already there in our, whether it's a managed portfolio, whether it's all access. But what I'm trying to say is, if you are not tracking this space, this is a space which has a lot of hidden potential right now. And again, Bitcoin has taken its own shape, right? Means I'm not comparing Bitcoin here because Bitcoin is more like a gold and so on. I'm talking about the other coins and the wider crypto industry, which is like you may have heard Tom Lee talking about Ethereum. Again, he's creating a hype around it. I don't endorse that in general, but some of the things he's saying are true, which is that whole unlocking of value of the Ethereum based products, whether it's stable coins, whether it is all the new launches, real estate coming into tokenizing. Coinbase is looking to launch tokenized securities or futures and options into the in on Coinbase app. All these things, the whole tokenization, it will take some time, but this will open up and unlock a lot more value. And that probably is currently in a hype phase. It will go through the correction and then it will again boom up. But that is one area which was, means I personally tracked a lot, and I know that technology exists. It's a matter of now using these new regulations to really benefit the growth in this industry, which is what I think is going to be a follow-up after AI. Similarly, I think people are underestimating what is happening in the automation, like in terms of robotics side, because AI had a leg of LLMs, and now you're talking about robotics. So when we say, going back to the whole discussion, right, the tech has two impacts. One is, of course, the stock running up. If you remember, in the last decade, why were we able to keep interest rates almost zero, or 1% or 2%, very low interest rates, and why there was no inflation? It is purely because of technology being very, very deflationary. Now, and we are talking about the technology was simply mobile phones, smartphones, and cloud. They were transformational, but they were not necessarily as game changing as some of the people in AI world are making us believe right now. So internet itself was huge. The smartphones and cloud was an incremental change. When we talk about AI and robotics, now robotics is a as big a change as internet in terms of productivity, in terms of inflation reduction. Because if you look at all recent years of inflation, and if you're listening to Powell very carefully, he always talks about the service sector and the wage growth being the primary contributor of the inflation. Means we keep forgetting that the minimum wages in US have gone up by 2 to 2.5x in last very few years. But so the trickle down effect of inflation, there was a huge component is coming from the wage growth, coming from the service sector and so on, services. Now, what we are seeing is the potential of technology. Again, I'm not making a social commentary whether it's good or bad. I'm talking about economic commentary of what is the promise of robotics. The promise of robotics is that you invest once, and you don't have to pay wages anymore. And these are the kind of things which are still in early stages. So when we say yes, tech stocks are frothy. Yes, we may have a problem in terms of inflation. What if there is a positive scenario a lot of people are talking about? One, I talked about there's a huge potential in crypto side. Then there's a huge potential on robotics side. And when I say robotics, not just because some breakthrough is happening, but actual deployment, bringing productivity as a somebody as a human, you need to hire three people to run a whole day shift. In a robot, one person or one robot may run whole day with a fraction of a cost. Your costs come down, your productivity increases, and you have a deflationary effect on overall in the economy. So you may have a long-term improvement, just like we had in last 10 years, where rates remain low, inflation is in control, and we have easy money taking us to a totally new heights, um, and we just spend our way to quadrillion dollars instead of trillion dollars. That's what I see as another path of the near future. So a lot of ifs and buts, I would say, in all of these scenarios. So nobody knows. But my view is very simple that when somebody tells you that the market is at all-time highs and everything is very high, we have lived through this. We have lived through this in internet. We have lived through this in 2007 boom of real estate. We have lived through this in after post-COVID. There are always these feelings which you get that, oh, this is the crazy frothiness and it cannot get it cannot go higher. But you never know. Technology has always surprised us, and the money world has always surprised us that you can always make the numbers go bigger. So that's just general ideas I wanted to make sure that everybody keeps in back of their mind. While my goal here is not to create a FOMO and yes, we are going way higher, I'm just saying that there are scenarios to play out. You need to ask yourself if you are invested long enough. You have to ask yourself if you have a plan, if it corrects. But it's all about having a plan, right? It's not about predicting, because as we always say that you cannot really predict what happens tomorrow or next year. Because for trading, you need to be right on the day trade, but on if you plan a portfolio or if you plan for your investments in a much longer horizon, it's much easier than you think. And that's where I think our goal is at Proflex, to keep educating and keep bringing those solutions to you. So that is all I had to say, in fact, and I had been thinking about. So if you have any other questions, please feel free to unmute yourself or put the comment in the chat.
So Raman, this is Naresh. I have questions. I know you generally don't comment on specific stocks, but any opinion on Target, which kind of fell today, and then also what is happening between AMD, Intel, and Nvidia?
Yeah, no, I think as I said, I'm not really following Target specifically, but in general, I would say it's a matter of what is going to benefit in short term. People were had high hopes from retail stocks, but I don't know specifically what's going on with Target on why it dropped. But in general, there is definitely a better feeling in the market about rate cuts and how it will affect. If you see, on the other hand, Walmart is at like almost all-time highs and doing very good. So it's very difficult for me to comment on what really went wrong because I'm not tracking Target. On the whole thing about NVIDIA, AMD, and Intel, my view is very simple that India is the leader now. NVIDIA is the AI bellwether, or they are actually basically the main pillar of this whole bull market. Intel is so tiny right now, and my expectation is that there must be some push from Trump administration because um, they did buy Intel stock. They did put that in the U.S. government assets or something as they are calling it, and they're thinking of it as like you have to bring up, and there is this whole rhetoric around how you have to bring up the manufacturing in U.S. How do you have to support U.S. companies? My expectation is that this is all this investment we are hearing about is that maybe a push from Trump administration in some kind of a deal they have achieved in the closed doors, where they say Nvidia invests here and they give some concessions to Nvidia for whatever licensing they had originally issued. On the other hand, what happened here is that China has already started telling their companies don't buy, so it doesn't even matter now whether they have the license to ship to China. So it will be interesting how that plays out. On the other hand, yeah, I think AMD is the perfect loser in both scenarios. First of all, they're losing because they're not able to compete with Nvidia. The second is that whatever they were seen as a follow-up, where they even in the PC market and so on, now that people are getting worried that Intel will start gaining against AMD on the on the CPU side, because the GPU side they're already second best, and they were gaining on Intel. But I think this is all overreaction in my book. Means I don't know the details, but my understanding is that nothing much changes, right? Means the trends are usually long-term trends. I think AMD has done very well, at least being second best. Intel is nowhere, so it will be interesting how this plays out. Other than just using some of their joint chip on PC side, or some kind of a small value segment. Like means whatever NVIDIA is doing with Intel is not really changing the AI path. It's probably going to affect a very small business segment, which is the PC side, or some of the server chips, and which are not really the biggest spending right now. If you look at the GPUs, the real spending. So my expectation is if AMD can maintain that, they will do all right if they're able to compete. So there is nothing new for them other than the sentiment getting hit. But yes, Intel definitely got a boost because they're so tiny that anything helps right now. Any positive news helps, because market had written them off in terms of that's a company which is dying. So it will be interesting to see if that really materializes with the help of NVIDIA. And but yes, we are seeing a lot more focus from even from Trump administration, because they are trying to bring this whole thing around the narrative around it, where to revive US companies and companies like Intel and so on. So that's a positive, I would say. But other than that, I have no opinion. I don't think anything changes for NVIDIA or AMD.
Thank you. Very good analysis. Thank you.
Yep. So yeah, I think this is good questions. I would say there are a lot of news floating around in the market, I know, and individual stocks, yes, there are a lot of impact can happen even in this market. And those are the things I think we don't cover usually in this, because our goal is to cover macro, and we do it under other products, where we are trying to discuss individual stock discussions and so on what we track and what we believe in. So do let us know if you have any questions in general on macro, and we can talk about that. Because overall, I would say if you are invested, I think it's a great time. I hope everybody is enjoying this upside. If you are not invested, it can be a tough time. You're sitting outside. So I hope that people don't FOMO into it. They should have a plan. And this is what we always say, right? Means you should if you do it in a hedged way, rather than doing it in a trading way. Do a portfolio manner. All right, so let me take one or two last questions. I see one in the chat. What's your take on global market with respect to macro? Yeah, I think it's a challenging thing, right? So global markets, I have always believed, and if any of you have attended, many of you have attended our May session and even December session last year in the Investor Day, I would say that we always talk about why US markets are the best place to be. We are lucky to be here. We are lucky to be, calling US markets as domestic markets. And this is the place to be because that's where most of the capital is flowing. Even the international money concentration in US is increasing. The problem with most of the international markets is that most of their fundamentals are shaky at best, because there is no technology development happening. Like, what is the world today? The world today is all about AI. World today is all about whether you are into either you should own manufacturing, which is owned by China, or you should own technology, which is owned by US. So China is probably would have been a great place if they were transparent. China was the best place to invest, second best to US. And China is so difficult to invest because it's a very small market driven by retail, and also because their accounting practices are unknown. There are a lot of fishy things which happen in Chinese market. So most of the smart money, big investors, they are scared of investing in China. We always used to have people analyzing Alibabas of the world and all. Yes, it has done great in last 1 year, and a lot of people have made money. On the other hand, I still remember people losing money every day, talking about how it is great value for 2 years before that, right? It was losing money every day, even though it was getting cheaper and cheaper on valuation. So it's very difficult to invest in those places. If you talk about EU, if you talk about any other countries, I don't know. There is no real benefit of investing in international funds, in my view. We have been running an India fund purely because India is a long-term story. Because of domestic growth, it is independent of the industry. Means India has no industry to speak of for international growth. It's purely relying on the population growth, the middle class growth, and that is a great place for if you are long-term invested. And we have been doing that as a hedge fund there. But overall, I would say there is nothing which excites me, and other than these three countries, US, China, India, are the only places Of course, we are biased towards India because we know it. I'm sure there must be other smaller countries which are good, but which I'm not sure, aware of. But bigger economies, only China and US are relevant, and China is not worth investing. Yeah, please go ahead. You can unmute yourself.
Oh, so you talked about coins a bit. So do you see a contrast between the future outlook for things like Bitcoin, more speculative, versus Ethereum, and or even stable coins like Circle or Coinbase? How do you contrast between them? What's your outlook for those three?
Sure.
And then the other comment is commodities with rates going down in short term, gold, etc., should get better prospects. Because why? Why is it? Because bonds are not as interesting anymore. But at the same time, stock market outlook is so positive that why would people go in commodities then in?
Sure. So no, I think to be frank, this is a good summary question you asked, which we have covered almost everything on a weekly basis in this call. So let me just repeat those but it's a good way to ask this question because now it gives me an opportunity to summarize how these individual things play the role in your investing. So, see, stocks are speculative in nature because they are very much driven by day-to-day news, right? Whether the stock, so yes, its outlook is positive, but we also talked about earlier in this call that stocks are usually run up based on the future. Stock, even though today's scenario macro is great for stocks, if people don't see any visibility of 6 months down the line, if they don't see anything positive coming out of it, stocks will start dropping. Stocks are not going to wait for earnings to top up. Usually the stock price peaks before the earnings peak. Usually the stock price bottom before even while earnings are not even going down. Stock market is trying to price 12 to 18 months out of in the time. Now let's talk about commodities. I consider Bitcoin as a commodity, so let's keep Bitcoin in that sector with the gold and so on. So Bitcoin, gold, all these things are going up purely for one reason that there's a money allocation going into these sectors purely for as an inflation hedge. When you have money supply going up day after day, when you have interest rates coming down in future, which will trigger more money supply because of the SLR rules. I know it gets very technical. We did cover it in detail in our investor day. We are going to cover these kind of macros in our upcoming investor day. But let me simply summarize that in a very simple way, you should think about easy money means more money can be issued by banks and the money supply increases. That's called my M2 money supply. That money supply starts going into assets and gold and Bitcoin absorbs that because now this is conservative. These are people who invest into gold, people who invest into bonds. They don't invest into equity market. Some of them cannot even invest into that because they don't have the risk appetite. It's not the same class. Commodities are same class. So you will see now there's a big section which is considering Bitcoin into commodity and digital gold. So Bitcoin has taken some of that market from gold, but in general, gold, Bitcoin, all of them take a percentage allocation. And that percentage allocation goes up when people are more worried about valuations in stocks and so on. So this is why gold is going up. This is why Bitcoin is expected to go up. Now, I covered the stock, I covered the Bitcoin and gold and so on as commodities. Let's talk about, you talk about the within the Bitcoin domain, the technology companies. As I say, all the altcoins and so on, they are all supposedly technology companies. They were unlisted securities. They were purely using a gray area in regulations to issue securities. Now they are trying to come back onto real security world, which is the stock market, by creating digital asset treasury companies. We've already talked about that for many weeks now. So you can go back and look at those YouTube videos. We have talked about digital asset treasury companies. But in short, what are they? They are basically relying on the crypto or the blockchain as a technology, and they are issuing something to invest in. All of them have very much questionable fundamentals because they are hyped up. But when you talk about Circle and Coin, these are infrastructure companies. These are companies which are building the bare bones of, this is kind of picks and shovel play, right? When you say AI has a future, NVIDIA is the beneficiary because they are providing the tools. They don't care whether AI succeeds or not. Right now, there is a hype. NVIDIA is making chips. Same way, Coinbase is building tools. They're an exchange. They are building e-commerce products using blockchain. They're providing you yield opportunities on your altcoins. They are basically providing all the tools. And somebody like Brian Armstrong, who's the CEO of Coinbase, he's sitting on the White House committee for defining the rules and clarifications on all these new laws. So they have the tailwind. But again, all these things are they priced in? I'm not suggesting you should buy it today. All I'm saying is they have the tailwind for doing better. Whether the stock price does well or not, it depends on the short-term outlook and long-term outlook by the investors. Now, when you talk about Circle, specifically, I don't like it because of the simple fact that their revenues flow into Coinbase anyway. They are not really enjoying the benefit, and with the new Genius Act and so on, even though they will benefit, there will be 10 other competitors soon. So I don't know what's their moat, but in general, I would say all these are going to benefit in general as an industry. But I don't want to go comment on individual stocks. But yes, in the earlier part of the call, I said there's an opportunity for the whole crypto sector where people are building technologies. One or two coins can do great, who are building the technology, who gets adoption. There can be these technology companies who can do great. But this is a more of a if and but, right? When OpenAI came, people did not know. When the ChatGPT came, nobody knew that how big the AI will be. It was every few months, it was a surprise when people said, oh, it's not a one-trick pony, it can do more, and so on, so and so forth. Crypto is in that stage right now where we are in early days of people seeing it as a promise. We are in this stage for last 5-6 years. But what we are in a stage where all that promise is now becoming real because of the regulations changing in US. Now, still, it has not happened. Still, nobody knows how big it can be. So that's what is a kind of we don't know yet. But yes, there is potential there. And within that, I may have different opinion on different stocks based on what their strengths are. Coinbase is a blue chip now because it's part of the S&P 500 and so on. So it is already identified as the leader in this space. So yes, that is the fact. But on the other hand, what will happen in short term, because these are all very high valued companies, their PE ratios are through the roof. So nobody can tell you if it is a good investment or not. So I'm just putting the whole picture of where they stand. And in terms of gold and Bitcoin and all, they have a totally different path, right? I mean, I can say that is a pure inflation hedge. And if you look at all asset classes, why everything is going up, the basic idea is that it's not going up, it's dollar getting devalued. And that is by design. Every fiat currency, when you are basically issuing 2 trillion of debt every year and you're adding new, means you have to refinance old debt, you have to add another 2 trillion, probably 3 trillion soon. You're basically issuing more and more currency, and it's a very basic economics 101. Economics 101 says when you have more supply of a certain thing, it becomes less valuable. So if you forget about dollar being money, think of gold being money, dollar being money, and everything, or dollar being commodity. If you keep printing more and more dollars, dollar value will go down. And because we measure every other asset class in a dollar value, everything goes up. That's the reality of today's world. So it's not really that gold is going up or stocks are going up. Yes, they are relatively going up because we have created a fake way of measuring their thing by using a dollar, which is by design a depreciating asset, which is being inflated, which is being issued at their whims every day by governments. And that is happening across the world. Every country is doing that, unfortunately. Some are more prudent with it than others. But US is not that one place where they care about it because they control the world. So I don't know if it was a long answer, if I captured the essence of your question, but this was an opportunity.
It was very good. Thank you.
Yeah, so it was an opportunity for maybe combining all the factors which we have been discussing.
For the people with FOMO, what's the strategy that works?
Don't FOMO.
That's on the
I would
sideline.
say if you feel FOMO, okay, actually it's a good question. Let me answer it in a different way. Means I know it can be FOMO is the worst thing you can do because market is not easy. I know that it's for a fact because I know a lot of people who enter late and this is where one thing I would tell you is stop watching CNBC. That is my recommendation to everybody. The worst place to get your financial information because they only care about what happened. They are a commentary on what happened where all the money is exiting. They are telling you to enter. Same is true for almost all mainstream news channels. I would say this is why we created this, right? This is why we do this macro discussions. The basic idea is simple, that FOMO happens when you feel, by definition, you missed out. If you missed out, why are you going now? You cannot bring time back. You cannot go back and invest at a lower valuation. So if you're already late, learn from it and find out what did you learn from it, note it down somewhere, repeat it to yourself and look for the next opportunity. Don't chase anything. On the other hand, what we do is in a different way because nobody knows the top either. So maybe when you think you're late, you are maybe 1/4 of the way on the upside. And when you don't know, this is why we call hedging. This is why we do options workshop. We do a lot of other things. In Proflex, we have never taken a single position ever where we don't have a plan to hedge, where we don't track it. So this is what we do. Means we are able to capture upside while protecting downside. And this is what we have been a big believer in. And we do it in our managed portfolios. We are doing it with a lot of new products being launched. So you can keep listening to us. We are actually going to do a options workshop also in October 5th, as we usually do. So do join these, and I think we can show you how not to FOMO and make a plan rather than just going blindly for a trade. Yeah, let's take a last question now.
Yeah, so I don't know if you saw this FT article where they interviewed a French hedge fund manager. He manages $20 billion, and he's a physicist, and he mentioned, I dropped the link, but he mentions that, like, one, he mentioned he found these papers that, like, I put the takeaways that this is what you were saying, is that liquidity flows and not fundamentals are a significant, if not the primary factor in this bull run, even more so than the zero interest rate paradigm. But like the question is, like, how does one hedge? Let's say, like, let's just take a hypothetical, typical accredited investor. They have 80% of their net worth in equities, like let's just say S&P to keep it simple. How do they hedge that? It's expensive to hedge it. I mean, how do you? Let's just take that specific example without making it too complicated. Someone who has like a typical accredited investor, 3 million, and they have 80% of their net worth effectively, and the S&P, maybe they own a house, right? And the rest of their net worth is in their primary residence. How are they supposed to hedge it for what these crashes that come out of nowhere? It's too expensive, right?
So you have basically touched the nerve on, exactly what I discuss every day with institutions, with the high net worth individuals who are coming into our products. This is a problem, and especially in Silicon Valley. Silicon Valley has the biggest of this problem because not just S&P 500, people are most of their net worth is tied into their company stock because they got it and they can't even sell it because it's a tax event. I mean, they are sitting on. I mean, one interesting call I had is where somebody said, I have tens of millions of dollars, but I feel poor because I cannot pay my mortgage because I'm sitting in a multi-million-dollar home. My salary doesn't cover my mortgage. And I said, why don't you sell it? Because that if you sell it, your net worth disappears, because the only way you can sell an appreciated asset is to make it disappear. Basically, you sell it and you cash it out. That it's not growing anymore. And this is exactly what we are resolving right now with Embark. So I cannot do it right now in this one. We are going to do another weekend session maybe Sunday. I will announce it tomorrow. This is actually that talks about exactly this. We are actually building products for these kind of things. When you talk about accredited, of course, we are talking about qualified investor, not accredited, which is another level up. But I'm talking about exactly what you need in this. And by the way, if you forget about that product, we have one session on this topic in our Investor Day on October 5th, which is happening on Sunday here in Bay Area. So do join that. I think we are doing very specifically this workshop because I'm hearing this every day from people who are sitting on equity and they don't know what to do, how to hedge it. But in short, one line answer, which is not going to be sufficient. It needs a full session. The short answer is that options are the way, because options provide you that. Yes, it is not easy for retail investor. That's why we do it in workshops. We do all these kind of details we are going to share. But basic idea is simple, that if you know math and if you know that if you just learn basics of options, there are a lot of ways you can do it. Unfortunately, that does not solve the problem if it's your employer stock. For your question, if you hold S&P 500, it's pretty straightforward, by the way. We are going to cover this in the workshop on October 5th. But if it is a case for you that it's your employer stock, you cannot do options because you're prohibited from doing that options, because that is called speculation on your own company stock. And that is why we are building this Embark product for people who cannot do it themselves, and how to do it in a more tax compliant as well as in a company compliant manner. On the other hand, we are going to talk a lot more detail. Basically, it's called you hedge your portfolio using either covered calls and a combination of we call it high convexity, high gamma squeeze kind of trades. It gets very technical in nature, so I don't want to cover it here, or it will be very difficult for me to explain it. But the institutions do it all the time. When you are why do you think when your brokerages give you 2-3% per year for your stock when they borrow from you if you're holding? Means basically they're making 10, 15, 20% return on top of it. So they are basically paying you that 2-3% because stock, if you hold, you can also make money from it. It's just that people don't know it. That's why these big institutions and brokerages are making money off you by taking your stock, and they are giving you this 2%, 5% returns on the year. And we are trying to bring those kind of products to retail individuals where you can do it. If you're a qualified investor, at least you can do it and not give that margin back to the big banks or brokerages. And that's something which we will cover in the Embark product also.
And I think the other problem is like there's other option, another like a very simple solution is just diversify out of equities. But then the question is, do you go into like even other asset classes? A lot of them are inflated too, and then other asset classes like private equity, they have illiquidity problems. So there's problems.
Yes,
so diversification. I don't know. I mean.
So diversification is a very bad idea in my book because if you see since the easy money supply since 2008, diversification does not work because everything is kind of correlated. When COVID happened, everything fell. You would not have benefited from that intraday crash or the next 1 week crash with gold or any kind of asset class like gold, Bitcoin, equity, bonds, everything fell like crazy. So what I'm trying to highlight is it's a money flow. You're right. Everything is money flow based. Everything is when margin calls hit, all multi-asset portfolios get liquidated. And the only way you can do it is true hedging on exactly same asset class. In fact, you should not diversify. You should build your convictions and hedge on the price, hedge on the tools available. And this is why I love equity, because equity has liquidity as well as hedging potential, and the option market depth is increasing every day. So there is a lot of potential there. So I would say don't even bother about diversifying. Yes, diversifying for long term works. I agree with you because these are uncorrelated. Diversification does not help you protect from short term crashes because everything falls when it falls. Diversification helps you in a medium to long term because every asset class has its own individual risks. Market risks, everything is same because of liquidities, because of the money flow. But the individual risks of something failing is much higher on a stock versus a gold or a Bitcoin because they have their own path, they have their own demand in medium to long term. So yes, diversification only will cover you for 5 year, 10-year horizon. It's not going to cover you for 3 months, 6 months, 1 year horizon.
Thank you. That's very helpful. Thank you.
All right, guys, I think we are over the time. It was great discussions. Let's call it a day, and we will share more information soon on WhatsApp over the weekend on the Investor Day, where to reserve your spot and so on. We are going to do more follow-up sessions on Embark. And as usual, I think we have a lot more, discussions happening in all our groups. We have a macro group, we have an all access group and options. Do reach out to our admins in case you have any questions, and have a great weekend. Thank you. Bye-bye.